approximately 300 billion US dollars. That number is not a typo. In February 2022, roughly half of Russia's foreign exchange reserves, the portion stored inside the US dollar system in Western custodian banks, were frozen overnight. Not stolen. Not spent. Frozen. Russia still legally owns every dollar of that money, but it cannot access it, move it, or deploy it. And the reason this story matters far beyond Russia is the signal it sent to every single central bank on Earth about the US dollar. A signal about who actually controls money in the global financial system and who does not. A signal that triggered the biggest, most underreported financial repositioning happening right now. Today, we are going to break down exactly what that repositioning is, from the architecture that built US dollar dominance, to the data showing how emerging markets are now dismantling it, country by country. This is the story of emerging markets, gold, and a deliberate, documented challenge to the architecture of US dollar dominance. Before we understand what is happening today, we need to understand the system that was built 80 years ago. July 1944, Bretton Woods, New Hampshire. 44 nations gathered to decide how the global financial system would function after World War II. The world had just endured 2 decades of financial catastrophe, the Great Depression, currency wars, competitive devaluations, and a global conflict. Every nation at that table wanted stability above everything else. The agreement they reached established the US dollar as the world's primary reserve currency, directly convertible to gold at a fixed rate of $35 per ounce. Every other nation's currency was then pegged to the dollar, making the dollar the singular anchor of the entire global monetary system. The reason the dollar was chosen was mathematically straightforward. In 1944, the United States held approximately 70% of the world's monetary gold reserves. The math made sense. The US had the gold, the dollar represented that gold, the world could trust the system. But here is the part that most financial education skips entirely. Because the dollar was the reserve currency, every other nation needed dollars to conduct international trade. To import oil, machinery, grain, every transaction between nations required dollars as the settlement currency. French Finance Minister Valéry Giscard d'Estaing described this arrangement as the exorbitant privilege. The United States could issue the currency that the entire world needed to function. That structural advantage meant the US could run deficits that no other nation in history could sustain, because demand for its currency was guaranteed by global trade dependency. And the world accepted this arrangement because at the time, the dollar was backed by real gold at a verifiable, fixed rate. That gold backing lasted exactly 27 years. August 15, 1971. President Richard Nixon appeared on national television. That address changed the global monetary system permanently. In those 15 minutes, he announced that the United States was suspending the convertibility of the dollar to gold. Effective immediately, without consulting a single one of the 44 nations that had signed the original Bretton Woods Agreement. The foundational contract of the entire global monetary system, rewritten unilaterally. Think carefully about what that action revealed. Every nation on Earth that had structured its reserves around a gold-backed dollar suddenly held a currency backed by nothing but ongoing trust and institutional dependency. The gold was removed from the equation, the dollar stayed, and the world had no practical exit. By 1971, the dollar was so deeply embedded in global trade infrastructure that abandoning it would have caused more economic disruption than accepting the new reality. From 1971 forward, the US dollar's reserve status rested on one foundation: the structural dependency of the entire world on a single nation's currency. Not gold. Not a fixed standard. Institutional dependency that self-reinforced, because the more the world used dollars, the more essential dollars became. This self-reinforcing loop is what economists call the network effect of reserve currency status. But the United States did not stop there. 3 years after the Nixon shock came the structural move that permanently locked the dollar's dominance in place. Before I continue, if everything I have covered so far is making you want to understand the full architecture of how the global monetary system actually works, from the ground up, I made a complete course on exactly this, titled Applied Macroeconomics. It covers central banking mechanics, sovereign debt, inflation, interest rate theory, global trade, economic cycles, market psychology, and the future of monetary architecture. The full operating system behind everything we are discussing in this video. Total course video content is more than 2 hours, and I have intentionally stripped out all the fluff. Every single minute is clarity and value. Email support is also included, so any questions you have, you can get them answered directly. The link is in the description. Now, back to 1974. In 1974, the United States reached a landmark bilateral agreement with Saudi Arabia. The arrangement was straightforward. Saudi Arabia would price its oil exports exclusively in US dollars. In exchange, the surplus dollars Saudi Arabia earned from oil exports would be invested back into US Treasury bonds. This became the petrodollar system, and its consequence is something every nation on Earth still lives with today. If your country needs oil, and every country needs oil, your country needs US dollars to buy it. To obtain dollars, nations must either export goods and services to the United States or hold US Treasury bonds in their reserve portfolios. Economists call this petrodollar recycling, and it created a permanent, institutionally enforced global demand for the US dollar. As of data from the Bank for International Settlements, the dominant share of global oil trade remains invoiced in US dollars. The petrodollar system ensured that energy, the most essential input to every economy on Earth, was structurally dependent on one nation's currency. So by 1974, 3 decades after Bretton Woods, the dollar dominance architecture has 3 distinct reinforcing layers. The reserve currency infrastructure from 1944, the removal of gold backing in 1971, and the oil dependency lock from 1974. 3 structural locks on a system that every nation on Earth depended on for international commerce. And the critical analytical question, the one this entire video is built around, is what happens when the nation holding the key to that system decides to use it as a direct geopolitical instrument? That question received its most documented, most consequential answer in February 2022. To understand what happened to Russia in February 2022, we first need to understand the plumbing of the global financial system. The global financial system runs on a network called SWIFT, the Society for Worldwide Interbank Financial Telecommunication. SWIFT is the standardized messaging infrastructure that banks use to communicate and transfer funds internationally. Every time a Russian bank conducted an international transaction, that transaction flowed through the SWIFT network. When Russian banks were disconnected from SWIFT in March 2022, those international transactions became structurally impossible. But the SWIFT disconnection was only one dimension of what happened to Russia's financial position. Russia held approximately $640 billion in total foreign exchange reserves as of early 2022. Of that $640 billion, approximately $300 billion was held in Western jurisdictions, accounts at the Federal Reserve Bank of New York, the European Central Bank, and Western commercial custodian banks. Those $300 billion were frozen. Western governments issued directives to their financial institutions: do not process any transactions involving assets of the Central Bank of Russia. Russia still legally owns that money. The key distinction between frozen and confiscated matters in international law, but in practical, operational terms, the effect on usability is identical. The assets exist, they are recorded, but they cannot be accessed, moved, or deployed. And the signal this sent to every non-Western central bank was immediate and analytically unmistakable. If your foreign exchange reserves are held in Western clearing systems and custodian banks, your access to those reserves depends on the political relationship between your government and Western governments. This concept was not new to financial analysts. The precedents existed. Iran was disconnected from SWIFT in 2012. Venezuela had assets frozen. Afghanistan had $7 billion in central bank reserves immobilized in August 2021. But Russia was categorically different in scale and geopolitical significance. Russia is a G20 economy, a permanent member of the UN Security Council, the world's largest territorial nation, and a major global energy supplier. If an economy of that strategic scale could have $300 billion frozen overnight, the institutional message to every non-Western central bank was explicit. No nation outside the Western alliance could continue to regard its dollar-denominated reserve holdings as unconditionally under its own sovereign control. Now, what I have shown you so far is the structure of the problem. The 3-layer architecture that created dollar dependency, and the event that exposed every nation's vulnerability within that architecture. But what happens next in this story is genuinely extraordinary. Because Russia, China, India, and Saudi Arabia, 4 of the most strategically significant economies on Earth, each made specific, documented, data-backed sovereign moves after 2022. And when you analyze those moves together and line them up chronologically, They reveal a systematic, documented shift in how sovereign institutions are managing reserve risk. In a few minutes, I am going to break down exactly what each of those nations did, with the specific institutional data behind each case. But first, we need to understand why gold specifically became the asset of choice, because that answer is the intellectual core of this entire story, and it comes down to one single financial property. Gold has one financial property that no other reserve asset in the world possesses: zero counterparty risk. This is the concept that makes everything else in this video make sense. Let me explain exactly what it means. When Russia held $300 billion in dollar reserves, those dollars existed as electronic entries in digital ledgers. Ledgers controlled by Western clearing institutions, Fedwire, Euroclear, SWIFT. Those institutions can be instructed by their governing authorities to freeze those entries, as we saw in February 2022. Now look at gold held domestically in your own sovereign vault. A gold bar held in your own vault is a physical object under your physical control. It has no password, it has no server, it has no compliance department in a foreign country that can freeze it. It exists independently of any external institution's decisions. The counterparty, the third party whose decisions can affect your asset, does not exist when gold is held domestically in your own sovereign vault. Gold is not a promise from any institution. It is not a claim on any counterparty. It is the asset itself. For most of the 1990s and early 2000s, this property was considered irrelevant by most institutional analysts. Central banks across Europe were actively selling gold during this period, in some cases at historically low prices, because the dollar system appeared structurally stable and trusted. The institutional consensus at the time was that gold produced no yield, had no modern monetary role, and holding it was operationally inefficient. Then 2022 happened, and global central bank gold purchases, according to World Gold Council data, which compiles central bank disclosure reports, hit 1,082 tons for the year. That is the highest annual level of central bank gold purchasing since records began in 1950. The same calendar year, the $300 billion of Russian reserves were frozen inside the Western financial system. The alignment between the sanctions event in February 2022 and the record gold purchasing data for that same year is documented, institutional, rational behavior. Sovereign institutions, whose entire function is managing national financial risk, responded to a visible demonstration of counterparty risk by increasing their holdings of the one asset with zero counterparty risk. So the question now is, who specifically is buying? How much? And what does the institutional data behind each major case tell us about their strategic reasoning? Starting with China, the most strategically consequential case in the entire analysis. China's gold accumulation strategy has been one of the most studied areas in sovereign wealth management for the past decade. China's official gold reserve figures, reported by the People's Bank of China, show consistent accumulation over the past decade. But the official figures are only the starting point of the analytical picture. Independent researchers who track China's documented gold import volumes have consistently noted a significant gap between official declarations and what the import data suggests has been accumulated. These are estimates derived from trade data, not verified government declarations, and I am flagging that distinction clearly. The strategic logic behind why China is accumulating gold is not complicated. China is the world's largest exporter. It generates an enormous, ongoing inflow of US dollars from trade. For decades, China recycled those dollars into US Treasury bonds, the same petrodollar recycling loop we covered earlier. That created a concentrated exposure. China's sovereign reserves heavily weighted toward the financial instruments of its primary geopolitical competitor. As US-China geopolitical tensions have intensified across trade disputes, technology restrictions, and strategic competition, the risk profile of holding concentrated dollar reserves has changed. Gold represents a diversification away from that concentrated counterparty exposure into an asset no external authority can freeze or restrict. China's simultaneous development of the digital yuan as an alternative infrastructure for bilateral trade settlement operates in parallel with the gold accumulation strategy. These are different instruments serving different functions, but they both serve the same macro objective: reducing the structural percentage of China's international financial exposure that is denominated in, or dependent on, the US dollar. Russia's gold accumulation strategy is the most extensively documented case study in this entire story. Because Russia did not begin accumulating gold in 2022. The systematic program began in 2014. In 2014, following Western sanctions related to the Crimea annexation, the Central Bank of Russia initiated a documented, deliberate program to reduce its dollar-denominated reserve exposure. Over the following 6 years, Russia purchased gold at an accelerated, consistent pace, building domestic holdings through multiple global market cycles. By 2018, Russia had sold virtually all of its U.S. Treasury bond holdings, replacing them with gold, euros, and Chinese yuan. The shift in Russia's reserve composition between 2013 and 2020 is one of the most dramatic documented cases of deliberate de-dollarization by a major economy. And here is what makes Russia's case the single most instructive data point in this entire analysis. When the February 2022 sanctions were applied, the portion of Russia's reserves held in domestically stored gold was not frozen. Only the reserves held in Western custodian systems were immobilized. The gold Russia had accumulated and repatriated to domestic vaults remained under full sovereign operational control throughout the entire sanctions period. I want to be precise here. This is not an endorsement of any political position or action. This is an analysis of documented financial data. The data shows that domestically held physical gold was the only major reserve asset class that maintained full sovereign accessibility when sanctions were applied to Russia. And that is the data point that every non-Western central bank studied very carefully after February 2022. India's gold story carries a different character from Russia's and China's, but it contains one of the most symbolically significant acts of sovereign financial repositioning in recent decades. In 2024, the Reserve Bank of India repatriated 100 tons of gold from the Bank of England back to domestic storage on Indian soil. This was India's first significant gold repatriation since 1991. 1991 is a defining moment in India's financial history, and understanding it explains exactly why this repatriation carries institutional weight. In 1991, during a severe balance of payments crisis, India pledged approximately 67 tons of gold, 47 tons sent to the Bank of England, and 20 tons to the Union Bank of Switzerland as collateral to secure emergency loans. India needed foreign currency to prevent a sovereign default, and gold was the only asset that could serve as credible international collateral fast enough. That 1991 episode is deeply embedded in India's institutional financial memory. The institutional memory of that 1991 episode, of physically pledging national gold to foreign institutions to avoid default, is part of why the 2024 repatriation carries more than just financial significance. It carries a sovereign psychological weight. The 2024 repatriation, bringing 100 tons of Indian gold from a foreign vault back to Indian soil, reflects a deliberate institutional decision about where sovereign assets are most securely held. A significant portion of global central bank gold reserves are physically stored at the Bank of England in London and the Federal Reserve Bank of New York, held on behalf of foreign governments. Gold held in a foreign vault, regardless of ownership, is physically subject to the jurisdiction of the nation where that vault operates. India's repatriation signals a growing institutional consensus among emerging market central banks that physical proximity of sovereign gold to sovereign territory is an independent dimension of reserve security. Saudi Arabia represents the most structurally consequential case in this entire analysis. Because Saudi Arabia is not simply a gold accumulator. Saudi Arabia is the structural foundation of the petrodollar system itself. We covered the 1974 Petrodollar agreement. Saudi Arabia prices oil in dollars. Surplus dollars recycle into U.S. treasuries. That was the architectural lock. That arrangement held with structural stability for approximately 50 years. In March 2023, the Wall Street Journal reported that Saudi Arabia was in active discussions with China about pricing a portion of its oil sales in Chinese yuan. The commercial logic is analytically straightforward. China is already Saudi Arabia's largest single oil trading partner by volume. The bilateral commercial relationship has grown significantly beyond the United States. Accepting payment in the currency of your largest customer is a rational commercial decision, independent of any geopolitical positioning. And here is where analytical precision matters significantly. This does not mean the petrodollar system is collapsing. The dollar has 50 years of structural infrastructure momentum behind it. What is happening is a gradual, documented erosion of the dollar's exclusivity in energy pricing, not the elimination of dollar pricing. The difference between a dollar monopoly on oil pricing and a dollar majority share on oil pricing is a difference that compounds in significance over decades. Each percentage point of oil pricing exclusivity that moves away from the dollar reduces the structural global demand for dollars, which affects U.S. borrowing costs, Federal Reserve policy options, and the overall scale of America's exorbitant privilege. The direction of travel is documented. The pace remains uncertain and dependent on multiple geopolitical variables. We have now covered a significant amount of historical and institutional data. Let me now synthesize what all of this means, and be analytically precise about what it does and does not tell us. First, the documented institutional data. Central bank gold purchases have been at historically elevated levels for 3 consecutive years, as of the most recent World Gold Council data. In IMF COFR data for 2024, the dollar's share of global reserves stands at approximately 58%, down from approximately 71% in 2001. That is a 13 percentage point structural decline over 2 decades in the dollar's share of global reserves. Now, and I want to be explicitly precise here, none of this data constitutes a prediction that the dollar will collapse, or that gold prices will rise, or that any specific financial action is appropriate for any individual. This is a structural analysis of documented sovereign institutional behavior. What individual people do with their own finances is entirely their own decision, and should involve qualified professionals familiar with their specific circumstances. What the data documents is a multi-decade, multi-actor, coordinated reduction in dollar reserve concentration, and a simultaneous increase in gold holdings by sovereign institutions. The direction of travel, based on the documented institutional moves, is toward a multipolar reserve system. Not a world without dollars. A world where the dollar shares reserve status with other currencies, with gold, and potentially with digital settlement instruments. The United States still operates the world's largest economy, the deepest equity markets, and the most liquid government bond market. Those structural advantages do not disappear because central banks are purchasing more gold. What is changing is the degree of exclusive dominance and the pace at which other sovereign institutions are building alternative infrastructure. The institutions executing these documented moves, central banks, are not ideological actors. Their function is sovereign risk management. Their decisions are based on documented risk assessments, not political positions. When central banks across multiple emerging market economies simultaneously increase gold holdings and reduce concentrated dollar exposure, that represents a documented institutional risk response. A risk response to a specific, documented demonstration that concentrated reserve holdings in a single counterparty's currency system carry sovereign political risk that was previously underpriced. The honest intellectual position on where this goes is to acknowledge genuine uncertainty about pace. Financial systems have enormous structural inertia. The dollar's reserve dominance took 3 decades to build from Bretton Woods. Structural transitions of this magnitude take decades to fully materialize. The scenarios that serious institutional analysts discuss range from a very gradual evolution, where dollar dominance reduces slowly over multiple decades, to more significant fragmentation, driven by accelerating geopolitical tensions. What all 3 scenarios share is the same direction: a reduction in dollar reserve exclusivity over time. The direction is documented in institutional data. The pace depends on geopolitical variables that no analyst can predict with precision. And understanding the documented direction, even without certainty about pace, is analytically valuable. Every financial headline about BRICS summits, gold price movements, yuan trade settlements, or US sanctions policy now has an institutional framework behind it that makes it analytically legible. That framework is what this video has built. I want to be honest about where I stand on this. I have studied this topic extensively: macroeconomics, central bank mechanics, monetary history, sovereign debt architecture. I find this institutional shift genuinely fascinating from an analytical standpoint. But what sovereign central banks do with their national reserves is categorically different from individual financial decision-making. I am not qualified to give financial advice, and I am not doing so. The value of this framework is not in telling anyone what to do. The value is in giving you the institutional chessboard, so that when you read financial news, watch markets, or study economics, you are seeing the full structural picture, not just the surface layer. Understanding the system, how it was built, how it is being challenged, and where the documented institutional data suggests it is heading, is the foundational level of serious financial literacy. If this video gave you a clearer picture of how the global monetary architecture actually operates, I want to point you towards something that takes this significantly deeper. If you want to go deeper on everything we covered today, the link to my applied macroeconomics course is in the description. If this video changed the way you see the global financial system, I genuinely want to know what landed hardest for you. Drop it in the comments below. If you found this analysis valuable, a like and a subscription costs nothing and genuinely helps this kind of in-depth institutional content reach more people who are looking for it. The videos appearing on your screen right now are the natural, analytical next step from everything you just learned. Every video on this channel is one more layer of that picture, and the viewers who stick around are the ones who eventually see the full architecture.